I'm joined by Matthias Joerss. He's head of equity strategy at Sal Oppenheim, and he joins us live from Frankfurt. Good morning to you. Just to first up, well, what are you looking for out of this confidence number today?
Well, to be honest, we are not very. We don't think that the expectations numbers will improve further. The current conditions will improve further, but markets are driven by expectations, and there we have seen weaknesses in the chemical sector already in the last couple of months, and frankly, I think this will spill more and more over into other parts, as chemicals are one of the best leading indicators within IFO.
Matthias, some people are saying that these numbers are perhaps showing too much optimism. What's your view?
I think at the moment the numbers are showing more optimism than we have for the current year. We think that the numbers are a bit exaggerated by the strengths which came from low inventories initially and by strong machinery orders as well. But we think that also the car industry is going to weaken further. So from our perspective, the numbers going forward will not improve further.
What does that mean for the economy? Does it mean that the German economy itself could perhaps be vulnerable to a double-dip recession?
No, we don't go for a double dip, but we think that equity markets at the moment are playing more a very pronounced recovery of the market. And so, frankly, we think that equity markets are a bit ahead of themselves, but we don't think that we are looking for a double-dip reset like anything similar.
How does the European Central Bank actually play into all this?
We think that at the moment there is not, the ECB doesn't have to raise rates anytime soon. We think that the market feared a bit that we will get a rate hike in the second half, and therefore all market participants, or a lot of market participants, expected that the equity market will have a good first and a weak second half. We don't think that that is the case. We think that the pressure on the ECB to raise rates is very moderate.
Right, so if equity markets are getting ahead of themselves right now, should you stay on the sidelines?
We think we are a bit on the cautious side. We don't think that there are any gains to be made in the first half.
Right, but if you had to invest, as a look ahead, where would you go?
We would be very positive on sectors like the pharmaceutical sector, which profits at the moment as well from a bit stronger dollar, and where we think that the valuation is relatively attractive. We would also go for a lot of sectors that are profiting from very high dividend yields compared to bond yields, like, for example, the telecom sector, which is rather not in favor of most market participants. And we think that, particularly in Germany, we also should see a bit more strength of the residential real estate stocks, because ultimately the situation, the European currency union is reversing from the beginning of the currency union, which means that we now probably have a monetary policy which is relatively easy for Germany, but not as easy for Southern Europe.
6 minutes to go before training gets underway. We've seen repeated losses over consecutive days now for Europe's equity markets. Is this the gut check? When do we get to decent valuations, or are we nearly there now?
We are not that far away from decent valuations. But let's face it, people were not have had high expectations for the reporting season. I think that the reports will continue to be relatively decent, but the outlooks will not support higher valuations. And on the other hand, from our perspective, the cash ratio at mutual funds have been rather low, particularly in the US,
Matthias?
but also in Europe. And so we think there is not too much to be gained at this point from equity markets here.
Matthias, thank you very much indeed. Matthias Joerss, the head of equity strategy at Sal Oppenheim, talking to us about IFO and also equity strategy as well. Quick